Hi everyone, thanks for tuning into Asset TV. I'm Michelle Yu, joined alongside a fixed income connoisseur. And let me introduce you now to Kevin Flanagan, head of fixed income strategy at Wisdom Tree. And I want to start by having Kevin provide an overview of the current fixed income landscape and how it has really evolved in recent years. Kevin, a pleasure to see you.
Thanks for having me. A pleasure to be here. I think it's almost a very simple answer to your question. It's the level of interest rates. We are no longer where we were, where it was negative rates, 0 or 1%. We have what we would consider to be a more normal rate setting. A lot of people say, no, it's higher for longer. No, if you go back in time and look at where rates have been, this is traditionally where you see treasury yields, investment grade corporates, muni yields. I mean, pretty much running the gamut throughout fixed income. And the natural question is why? Well, I think it's been an evolution in terms of the macro backdrop as well as monetary policy. So you no longer have the Federal Reserve sitting at 0 or the European Central Bank at negative rates. Even Japan has gotten into the mix, right, and started to raise rates as well. And the macro backdrop combined with the monetary policy backdrop has put us back to where we feel interest rates should be in this environment and will no doubt remain as we move forward. If you just look at, historically speaking, where we have been, when you go back to that pre-financial crisis, for the 20 or 30 years or so, the numbers we're seeing now is what investors were used to. So I like to say we're now witnessing a generation of investors have to get used to this new rate setting. If you go back just to where we were prior to the first Fed rate cuts, people used to ask Powell, Chairman Powell, the question as, well, where do you see rates going back to? And he would kind of couch it and say, we're not going back to where we were pre-COVID, per se, meaning those 0 or 1, 2, or 2% kind of levels. And that, I think, is something that investors need to focus on. We're not going back anymore. We're going forward with respect to interest rates or remaining where we are. And so even if the Fed does cut rates a little bit more this year, if you think about where it started from, it was 5.25% on the Fed funds rate. They dropped you a full percentage point. So even if they cut rates a couple of more times, you're still talking about something in the high 3s or around 4%. And for investors, it's a way to take advantage of fixed income because you're seeing these yields now where there's actual income and more of that traditional role for fixed income in an overall portfolio.
I think one thing that a lot of people are interested in knowing is what the primary drivers are for focusing on a passive active strategy right now. What do you think?
Well, I think what you're trying to do is take a look at where we are, A, back to the level of rates, and then B, trying to figure out what the Fed's going to do, what's the macro, what's happening in Washington, D.C. That's changing almost on a weekly basis for sure. So the active passive approach is the cornerstone is the passive, and that's Treasury floating rate notes, and that's our fund USFR, where you can garner income without a lot of the volatility you're seeing in longer duration. And that's where the active comes in. If you want to try to lock in yield further out on the yield curve, further out in duration, maybe take advantage of total return, you combine the two and hopefully you get the best of both worlds in fixed income with just 2 line items.
So what do you think sets your strategy apart from everyone else in this space? I'm putting you on the hot seat here.
I enjoy the hot seat. So A, the Treasury floating rate is rather unique. Matter of fact, still, they were issued back in 2014, same with our ETF. A lot of people still are not familiar with that. You think floating rate note, you think, oh, okay, corporate floaters think, no, these are treasuries, 100% treasuries. But for me, it's the active part. And there's 2 ways of looking at it. We have one, Aggie, that's our enhanced yield ag. That's more income focused. Let's call it Modern Alpha, Smart Beta 1.0. Or you could do WTBN, which is our Bianco Total Return Fund, which is more traditional in terms of focusing on total return. And what's interesting about that, once again, the evolution of what we've seen, if you go back 10 years ago, you did not have active bond ETFs. You had the ag, but you would go to a fund manager. Now you have this type of a solution in the ETF wrapper.
So how do you see this type of approach fitting into one's portfolio?
It's the benchmark, right? So it's where you start for fixed income. So for us, it's kind of core. So you have the Treasury floating rate, you combine it with the active part, and then maybe you want a plus component on there as well. Maybe you want a little bit more income, but those are the building blocks, the benchmark for your fixed income portfolio.
Are there any key risks that you want to tell us about, as we continue out throughout the year here?
It's uncertainty. That's the buzzword. Markets hate uncertainty, and that's where we're at right now. We're not quite sure. What is the Fed going to do? Rate cuts? How many? What would be the magnitude? What else is going on with the tariffs, with some of the other kind of changes we may see in the legislative part of the equation as well? So that's going to be something hanging over the market until we get some answers.
And how do you ensure investors that it will be okay, even though you don't know it will be okay?
Well, that's the approach, right, that we're taking in the fixed income. By using this barbell active-passive approach, you hopefully can navigate some of the shoals using my Cape Cod reference in sailing and get through some of these uncertainties that we have with us.
I like that. Kevin Flanagan, thank you so much for joining us and creating this great space for us and giving us great insight.
Thanks for having me.
All right, and that'll do it for us here on Asset TV. I'm Michelle Yu. We'll see you next time.